Welcome to Casual Finance Friday, episode 4. My name is Steve Higgins, financial advisor here with Higgins and Schmidt Wealth Strategies in Denver, Colorado. It's March 21st, 2025, and it is the first weekend of both the men's and women's NCAA basketball tournaments. Now, this is pretty much a holiday season around here. We take this very, very seriously. We also take our Casual Fridays very, very seriously. So, yes, we are hard at work, but today it's extra casual. I've got my ball cap on here because we are celebrating the basketball tournaments. Also, I've got my trusty Wilson to join us for the episode here today as well. And I'm going to hold it as kind of an anxious device for myself. So that being said, with all of this talk about bracketology and the tournament, it reminds me that it's not just basketball tournament time, it's also tax season. And so we want to talk to you a little bit about another type of bracket, your tax bracket. We've got two ideas for you that we want to give you today as you head into the weekend. This is Casual Finance Friday, with the purpose of this series being to send you off into the weekend with some actionable advice that you can use to better your path and better able you to meet your long-term retirement, financial independence goals and strategies as well. So the first idea that I want to give to you is the state tax retirement income exclusion. Now, every state is different. Here in the state of Colorado, they allow you to exclude some or all of your retirement income, and that retirement income can come from Social Security. It can be a pension distribution from something like Colorado Para or the Denver Employees Retirement Plan. It could be IRA distributions. Now, what the state allows you to do, if you are 55 or older, you can exclude up to $20,000 of this retirement income per person, okay? If you are over 65 years of old, you can exclude $24,000. Now, if you make, as an individual, if you make under $75,000 a year, you can exclude 100% of your Social Security. If you are a couple making $95,000 or less, you can exclude 100% of your Social Security as well. So a common mistake that is made where people miss this opportunity is, let's say a couple is distributing money out of their IRA, out of their IRAs to fund their retirement living expenses. And it's just easier to take it out of one spouse's IRA rather than have two separate distributions. Well, what happens there is you're likely to miss out on the $20,000 exclusion or $24,000 exclusion if you're over 65 for the other spouse who's not taking the distribution. So be sure you're taking $20,000 or $24,000 out of both spouses' IRAs. It's an easy way to save you $1,000 because of the state of Colorado retirement income exclusion. Now, like I said, every state is different. Some states allow you to exclude all of your retirement income. Some have it more graduated and some are more limited. So be sure to check out what the retirement income exclusion is in your state. Certainly reach out to us if you have any questions. Second idea I want to give you is the idea that a lot of people have heard about, but we find that very few people on their own are actually doing this. It's the idea of tax loss harvesting. Now, as we know, markets go up and markets go down. Now, there are periods of volatility that may have a different narrative, but at the end of the day, they all seem to turn out about the same way. So during those periods of market volatility, as investments drop, an investor is able to claim the difference between what they paid for investment and what the current value is if it's less, to claim that as a tax loss. But you've got to be actionable. You've got to be able to keep your head about yourself during some rough market waters to take advantage of this strategy. So let me give you an example. Now keep in mind, this needs to be done in a taxable account, like a single account, a joint account, a trust account, something like that. This doesn't work in retirement accounts like IRAs, Roth IRAs, 401ks. This needs to be a taxable account in order to do that. So let's say you buy an exchange-traded fund, which represents a bunch of large cap established U.S. companies. There's all kinds of exchange-traded funds out there. For example, let's just take the one I just mentioned. And you invest $100,000 in that fund, and then the market experiences a bout of volatility, and the value of that fund goes down to $80,000. Again, totally normal occurrence in the market. It should be expected. Now, if you are able to sell that investment, you are able to capture the $20,000 difference as a tax loss. Now, the other side of the strategy is that immediately you buy another investment. Now, the IRS requires this not be substantially identical. They are pretty vague when it comes to the definition of substantially identical, but I can tell you that you can't sell one stock and then immediately buy the exact same stock. That would violate what's called the wash rule, and it would disallow the tax loss. So again, I'm going to recommend that you get financial professional help with this. Certainly we do this for our clients, and I would suggest you find somebody to do the same. So what you're able to do is take that $20,000 loss. It goes onto your tax return and it's carried forward indefinitely. They never expire. The $20,000 of the $20,000 or whatever that loss would be, you can write $3,000 of that against ordinary income each and every year. And there is no cap to how much you can use of that loss to offset future capital gains. So it basically rides along on your tax return from year to year. $3,000 of it will be used against ordinary income, and then the rest of it is carried forward until there's a capital gain that you can use to offset. Now, this is really meaningful. If you have a business or a future property sale that you see in your future, it's never too early to start accumulating tax losses as the market presents those opportunities and be able to use those down the road to offset that really heavy tax burden that may be coming your way in the future. Now, we know that a lot of times people look at nasty market cycles and periods of volatility and they just don't want to look. They don't want to open their statement. Now, that's better than cutting and running, but I would advise you during those periods of market volatility, it's one of the best times to be tactical, be disciplined, and have a process. A couple things I really want to make sure that people understand here. The first and foremost is this is not an excuse. This is not an excuse to sell during a down market and make the pain stop. You know, when markets get volatile and things get nasty, there's that fight or flight part of our brain, that response that really tells us to make the pain go away and to stop. And it can sometimes make us feel that selling an investment and waiting for a better time when the skies are more clear to invest. Now, we don't buy into that. We believe that having the success and the long-term returns of the markets depends on you staying the course and having a defined objective and process, and that's what we do for our clients. Again, I would recommend that you do the same, or certainly find a financial professional that can help you with that. So the second, again, is just make sure that you understand the difference between what is substantially identical and what is different enough so that you can occupy a similar, if not the same place in the market without violating that IRS wash rule. Get some help. It's important to get that right. So again, wrapping this episode up, back to my picks for March Madness and the men's and women's NCAA tournaments. So let me put this away. All right. First, to the women's tournament. Now, some of you may know that I have a daughter who's a student athlete at the University of North Carolina. And not just because of that, although it does encourage me, I'm picking the women, the Tar Heels, to bring the championship trophy back to Chapel Hill. It's their time. They're ready. They've got the team to do it. And if you know anything about Chapel Hill, you'll know what it means to say I think they're going to be lighting the tower blue here pretty soon. All right, with that, some of you may also know in an awkward Thanksgiving dinner experience at our house, I have a daughter who attends graduate school at Duke University, also in North Carolina. She lives just 15 minutes away from her little sister. But I am picking the men Blue Devils to cut down the nets and bring them back to Durham and bring yet another championship back to Duke University. I'm not picking these schools just because my daughters go there. They're exceptional basketball programs on both the men's and women's side, and I think they're going to do very, very well this tournament. So with that, I want to wrap up this episode of Casual Finance Friday. Thank you so much for joining me. Thank you so much for being part of this. Please share this with your friends, with your family. Really, really enjoying this time. It's exciting to be putting this content out there. I love hearing the feedback. If you have any ideas or thoughts or questions, something you might want us to cover in an edition of Casual Finance Friday, I would love to hear it. With that, have a wonderful weekend, and of course, happy Friday.